The big difference is, coming from South Africa, I'll call it the ostrich strategy. What ostriches do when danger lurks and there's big risk is they put their head in the sand. And that means I don't know. And if I don't know about it, then out of sight, out of mind. And most people see directly investing in the stock market or property or whatever as a difficult thing to do. And there's a lot of jargon and understanding. So they halve it off, they outsource it. And so that they are not on a daily basis getting the feedback from the market as to what's going on, whether it's up or down. Whereas the active investor is getting feedback on a daily basis, and sometimes a couple of times in the day. For people that look at the market during the day, they're getting feedback all the time, and they're having to process that, which would be linked to basically a pain avoidance and emotional pain avoidance. And that is where we have to instill process, not to get sucked into that. And that is what people have the most difficulty with. And effectively what happens is short-term volatility affects long-term planning. So what people are trying to achieve in the long term, gets pushed to one side based on the short-term feedback they're getting. Whereas in a managed fund, third party, they're not seeing that short-term feedback, and therefore they're not reacting to it. The reason most people don't manage their own money is fear. It's fear of their own capabilities, and then fear of the market. People need to be able to have an open mind that they can do it themselves,